Well, those were the headlines. Let's welcome on board our very first guest on the show, Vinay Paharia. He's the CIO of Union Asset Management Company, and they have released a very interesting white paper on something called as factor-based investing. And what they've done is essentially they've decoded which exactly are the factors that have worked for Indian equities. But before we get into factor investing and what's worked, I think many of you may be actually asking yourself the question, what is factor investing in the very first place? So Vinay Paharia, welcome to the Money Show, and thank you so much for taking our time and joining us today. Let's start off with that first, before we delve into all the details of your report. What exactly is factor-based investing?
Thanks, Mabina, for having me on the show. So what we wanted to do is to identify what are these financial parameters which investors can look at to generate, to create portfolios which are optimal portfolios which can generate superior returns over a longer period of time. Of course, there have been a lot of academic studies which have been done in the past, but most of these studies are concentrated in developed world like the US or Europe. Many a times we have not seen studies which are very practical and less academic. So our objective was to understand what are those crucial financial parameters, or in your language, mantras, which have worked in investing and has helped generate superior investment performance over a longer period of time. So that's what factors are all about. They are simply financial parameters based on which you can create portfolios.
All right. So what are the factors that, experts look at when they have to pick a stock for their portfolio? Just give us some examples of these factors. Sure.
So there are various financial parameters which many of us investors do keep looking at from time to time. Various studies have been done as to identify which of these factors, either in isolation or in combination, have helped create portfolios which have actually delivered superior returns over a longer period of time. So we have tried to look at various factors and have tried to identify the ones which have actually delivered superior returns over a period of time. So for example, we have looked at factors like growth in earnings. We have looked at factors like quality of business. We have looked at valuation, and we have also looked at momentum. And in addition to this, we have also looked at and eliminated factors like size, which means large, mid, small, like volatility and liquidity. We think that they have not yet passed the muster in terms of generating superior returns, and hence we have not highlighted them in our study. So what we have actually come to a conclusion and have highlighted are these four factors, which is growth, quality, value, and momentum, which according to us have proven that factor premium exists in India. Or in simpler words, it means that if investors create portfolios using these factors, they can generate optimal returns or superior returns over a longer period of time.
Okay. All right, understood. Now, let's talk then about what your paper says. When you say factor-based investing, and you mentioned, several factors as well. You've done a lot of, I can see a lot of deep dive done for all of these factors. What is the key observation? What stands out when you look at factor investing, especially in terms of performance, right? Because at the end of the day, what we want from equity investing is good returns.
Absolutely. I think investors have a plethora of choices today, and they are bombarded with words like index investing, quant investing, fundamental investing. So everyone is confused as to what do we look at, what works, what doesn't work. So what we've tried to do is try to look at what works, and have tried to bring out a simpler guide tool for investors to understand that what should we focus on. So just to dive deeper into the conclusions of the report, what we have observed by looking all at this data of about 1100 plus companies analyzed over the last 10 years is that one, quant investing works. It means all of these four factors, growth, quality, value, and momentum, have helped create superior returns over a period of time. Secondly, what we have interestingly also observed is that forward-looking prospective data, which involves fundamental analysis and human intervention, has delivered consistently more robust results compared to just analyzing backward-looking retrospective data. So that's what is the big conclusion, that fundamental research with forecasting has to be blended with quantitative factors to deliver superior returns. And hence, quantamental approach, which is a combination of quantitative and fundamental approach, could deliver superior returns over a period of time. So I think this is the big picture outcome of this study.
You know, overall, what we've also witnessed is that factor-based indices, I mean, you know, you can track that on the NSE website as well. We have a lot of factor-based indices like the Nifty 50 Equal Fund, that's just one among many. They seem to have done better than the broader indices like, you know, the Nifty or the Sensex, etc. What do you think has aided this? Why do you think these factor-based funds have actually done better than the broader indices?
So, Babina, we have precisely tried to decode some of these aspects using our research paper, that some of these factors have actually delivered superior returns over a period of time, and hence indices or quantitative portfolios which have been constructed using some of these factors have delivered superior returns. However, what we have also interestingly observed is that historical data analysis on which these portfolios have been created or these indices have been created have not done as well as looking at future or prospective data has. So when you look at future growth rate, for example, that will potentially deliver you a much superior portfolio compared to just looking at the historical growth rate and creating portfolios. So I think that is what is a big outcome, that yes, some of these factor portfolios or factor indices have done well, but you can do much better by creating such indices if you have the capability to forecast from a futuristic perspective, which is of course a blend of quantamental.
Okay, so basically, Vinay, if we had to just summarize, again, for the benefit of our viewers who may be just tuning in, what's the best way then to invest? It's a combination of looking at these factors along with fundamental research. If you could just summarize that for our viewers as well before we move forward.
Sure. So yes, I think you got it right. The best way for investors to create portfolios is to look at fundamentals of companies, look at their quality of businesses from a future perspective, look at the growth from over a period in future, and then use this data on a quantitative basis to create portfolios which, according to us, can deliver superior results over a period of time.
All right, understood. Now, you know, there are obviously more than one factors. There are many kinds of factors. Under what market circumstances do what kind of factors do well? There's growth, value, quality. So how do you decide what factors should you deploy in an investment strategy? Because, you know, let's assume that you may not really be an astute market investor. So how can retail investors use factor-based investing in different market conditions?
Sure. So I think one of the highlights of this study is also to make it simple. An investor will find it very difficult to understand, time the market, whether this is a bull market, bear market, whether the economy is going to do well or not. So all of these aspects are a little difficult. And we have also not tried to incorporate a lot of complicated stuff in this. What we have tried to analyze is simply over the last 10-year period, in various market scenarios, which are those factors which have worked. And all of these factors have worked in varying degrees. So what we have observed is when you look at future data, for example, growth has delivered the most superior return, followed by quality. And when you look at retrospective data, which is when you create portfolios only looking at historical data, in that scenario, momentum has delivered the best returns. So this is what, according to us, is the big picture conclusion.
Okay. So when we look at past data strictly and then accordingly invest and make a portfolio, momentum has done well, but otherwise it's growth that has actually performed better than value, and that's what we have seen for prospective portfolios as well. So basically stocks that do have high growth, what we call as an HUL, they are not necessarily cheap, of course, that's another point to consider, but they are high growth stocks. They have good top line growth, if you could call it that, good EPS growth as well. So that category of stocks have actually performed well for investors, and that particular method of investing, that particular factor of investing would be growth in this case. Now that's what has worked well in the Indian market. Based on your prognosis for the equity markets, for the setup that we are at currently, based on what we are seeing in terms of quarterly results, management commentary, taking all of this into consideration, what factor do you think will work best going forward for the Indian markets?
I think, Mubina, that's a good question. What we have deduced is that there is no one factor that you can simply program and create portfolios. What we need is a combination of factors plus future analysis and forecasts. So according to us, if you are able to forecast some of the aspects of these factors going down 3 to 4 years into the future and create portfolios using statistical methods, which of course is what quantitative investing is all about, then I think that's the secret mantra for creating portfolios. And that also highlights the importance of having an investment process. So this is what is important. Fund houses like us have always followed a process which is very scientific in approach. And I think this study is also going to help us improve our investment process so that it ultimately results in better outcomes for investors over a period of time.